Welcome to the deep dive.
Yeah.
Okay, if you're keeping an eye on the housing market, maybe especially in rural or suburban spots,
hmm
then probably the number one thing affecting your buying power is the USDA mortgage loan limit.
Absolutely critical.
So today we're doing a really vital deep dive into the latest projections for these limits. We're talking 2025.
Yeah, and this is, crucial info, especially if you're maybe a first-time buyer. The USDA Rural Development Program, it's just this huge engine for homeownership
Huge.
because it's one of the few ways to get zero down payment financing. That plus really competitive rates.
Right.
It hits that biggest hurdle for so many families, particularly moderate income ones, saving up that down payment.
Exactly. And our source material, it's suggesting some, well, pretty significant shifts coming for 2025.
That's what we're seeing.
So we need to get beyond just, reading out the numbers. Our mission today is sort of twofold. First, let's unpack the mechanism. How does the USDA even calculate these limits? Because they vary so much depending on where you are.
Wildly, yeah.
And second, let's analyze the impact. What does this projected increase actually mean for your buying capacity, for your financial qualification?
Okay, let's start with that mechanism then. Fundamentally, the USDA loan limit, it defines the absolute max amount you can borrow, right?
The ceiling.
The ceiling. But, and this is key, it's not one single number for the whole country. It's hyper-localized.
And that localization, that's what makes it tricky, isn't it? Like, unlike, say, a conventional loan where the limits might be pretty standard across a whole state, maybe?
Right, much broader.
The USDA really tailors its limit based on the actual economic reality of the specific county you want to buy in.
Precisely. These limits are directly tied to local median home prices. So if property values in an area are high, the USDA has to raise the limit there, otherwise the program isn't useful.
Makes sense.
But the amount, it varies.
Yeah.
It's dramatic, and that's why you absolutely have to check the specific map for your area.
Can you maybe give us a concrete example? Because just saying it varies doesn't quite capture the scale, does it?
Sure. Think about the data we looked at. You take a traditionally high-cost area, maybe San Benito County in California.
Okay.
Its maximum USDA limit might push well over, say, $700,000. Why? Because the median home value there just demands it for the program to work.
Wow. Okay.
Meanwhile, you could have a smaller, more traditional rural county, maybe somewhere in Missouri. Its current limit might be sitting much closer to the national average, which was around $377,000.
Huge difference.
Massive. And it really highlights the kind of market pressures the USDA is trying to navigate across all these different places.
So, okay, if they're not using just a simple national standard, what's the actual secret sauce? How do those four main factors interact when they set that specific county ceiling?
Well, the USDA uses this data-driven model, right, with four main things. The first two are pretty intuitive: median home price in that county, and the property type, like single family and occupancy status, owner-occupied.
Yeah.
But the third and fourth factors are really critical. Average borrower income in that area and regional market growth patterns. They don't just look at the house price in isolation.
Okay.
They look at the financial capability of the people the program is actually designed to serve in that specific location.
So what happens if, like, the average borrower income is relatively low in a county, but maybe home prices suddenly shoot up because of, I don't know, regional growth nearby? How does that tension affect where the USDA sets the limit?
Yeah, that's where the program really shows its flexibility. The limit is often set to reflect about 115% of the median loan amount in that area.
Okay.
But they also apply caps based on income. The goal is to make sure that even with zero down payment, the mortgage payment itself is actually sustainable for a moderate income earner.
So keep it high enough to buy a house, but not so high it immediately sinks the borrower.
Exactly. You want them to be able to buy a qualifying home, but you don't want them instantly debt burdened.
That brings up maybe a competitive angle. When we look at this data, how are these USDA loan limit increases tracking compared to other loan types, like FHA or conventional limits? Does that tell us anything about the government's focus?
That's a good question. Historically, USDA limits have often been a bit more conservative compared to, say, conventional conforming limits.
Right.
But they tend to track pretty closely with FHA limits. FHA is also government-backed, often targets similar first-time buyer groups.
Makes sense.
So the fact that the USDA is projecting this 3% to 5% increase, it really suggests they're acknowledging how fast the market is appreciating right now.
They have to keep up.
They do. If they didn't keep pace, the program would quickly become irrelevant in many of these growing suburban rural fringe markets. So this increase, it's a direct signal, I think, that the government is prioritizing keeping that zero down payment option viable in these specific sectors.
Okay, that makes a lot of sense. So now we know how they calculate it. Let's get to the burning question.
Yeah.
The national numbers for 2025. What's the big projection our sources were highlighting?
Right. The big takeaway is definitely the expected increase. USDA loan limits for 2025, they're projected to see a modest but I think important rise, generally around 3% to 5% in many areas.
Okay.
This is basically the USDA adapting to the reality of, well, housing cost inflation pretty much everywhere.
Let's try and nail down that numeric shift, though, the actual nugget people might be waiting for to, plan their budgets.
Right.
Where were we roughly and where are we likely landing?
Okay. So in 2024, the average cap for a single-family home in what you'd call a standard county was around $377,600.
Got it, 377.
Yeah. The early projections suggest that for 2025, that average ceiling is going to shift upwards, probably landing somewhere between, let's say, $390,000 and $395,000.
So an average jump of
Maybe
maybe $17,000 to $20,000 in maximum financing ability.
yeah.
Is that enough, though? Is that a genuine advantage? Or is it really just keeping buyers treading water against inflation?
Well, that's the critical question, isn't it? And while, yes, it does track inflation to some extent, that extra, say, $17,000, it could mean that a family who is previously just priced out of a certain neighborhood or maybe a slightly larger home.
Right, the one they really wanted.
Exactly. Or maybe one closer to schools or work. Now, they might be back in the running for that house, and crucially, without having to somehow find extra cash or get complicated secondary financing.
Okay, let's maybe run a quick hypothetical then. Say a buyer got pre-approved for the 2024 average max, that $377,600. And they kept losing out on bids for homes priced just a bit above that, maybe $385,000.
Happens all the time.
Right, so this new projected limit may be up to $395,000. That gives them a solid $10,000 buffer to compete more effectively. That can absolutely make the difference between getting a starter home and, while staying on the sidelines, renting.
Precisely. The implication is pretty significant. It genuinely expands access to slightly higher priced homes. And for families who are already kind of pushing their debt to income ratios.
Which many are.
Yeah, avoiding the need for like a second mortgage or some private loan, that's absolutely essential. It keeps their monthly budget stable.
Okay, so beyond just the price tag of the house, let's talk qualification math. Because the maximum loan amount is kind of useless if the borrower doesn't meet those ratio limits, right?
Absolutely. Max loan amount doesn't mean automatic approval.
So what are the key ratio lines the USDA enforces? The ones meant to ensure, financial stability for everyone involved.
Right. These qualification ratios, they're designed to protect both the lender and the buyer. They look at two main categories of debt. First is housing expenses, what's often called PITI.
And just quickly, for anyone unfamiliar, PITI stands for?
PITI is your principal, interest, taxes, and insurance, your total housing payment. The USDA generally likes to see that limited to about 29% of your gross monthly income.
Okay, 29% for housing. What's the second one?
Second, they calculate your total debt-to-income ratio, or DTI. This includes everything. Your proposed housing payment, PITI, plus all your other monthly debt payments like car loans, student loans, minimum credit card payments.
Everything.
Yep. And that total sum is generally limited to 41% of your gross monthly income.
Okay, 29 and 41. Those sound like pretty firm lines in the sand. But, in lending, there's often a bit of wiggle room, isn't there?
Yeah.
What about a borrower who might be pushing up against that 41% DTI limit?
Yes. That's where the idea of compensating factors becomes really valuable. It's a key nuance in USDA lending, actually.
Compensating factors.
Yeah. So while 2941 is the general guideline, borrowers who have an exceptionally strong financial profile overall, they might potentially qualify even if their DPI is a bit higher than 41%.
Okay, so what counts? What specifically does the USDA consider a compensating factor?
The sources we looked at outline a few key examples. Basically, the lender is looking for solid proof that the borrower can reliably handle slightly higher payments.
Like what?
Well, the most common ones are things like having substantial savings or reserves left over after closing the loan, not just scraping by.
Okay, cash cushion.
Right, or maybe documented job stability, like being in the same job or field for many years. A really strong, excellent credit history showing perfect payment habits is a big one.
Makes sense.
Or sometimes, if they're moving from renting, they can show proof that their previous monthly housing cost was actually higher than what their new mortgage payment will be.
Ah, showing they can already handle that level of payment.
Exactly. If you have those kinds of mitigating factors, the lender often has the flexibility to approve the loan even if the DTI creeps above that 41% mark.
That makes the qualification math feel, I don't know, much more accessible
Hmm.
and potentially more valuable, right? It's not just a hard no at 41%. It's about presenting your whole financial picture, showing stability.
It really is. It's a more holistic look.
And just to confirm the standard loan term, what are we typically looking at for the USDA program?
The vast majority of these USDA loans, they're structured as fixed-rate 30-year terms.
Okay.
which offers that maximum payment stability, especially important for those moderate income buyers, the program targets.
Right. Okay, let's maybe shift focus now, look at the big picture for a second, the policy context. Because this continuous need to raise the loan limits, it kind of highlights a central tension in the program, doesn't it?
It really does.
The policy papers we analyzed, they talk about the government's goal being, ensuring homeownership is sustainable, both in growing markets and in traditional rural areas.
And that tension often comes down to the definition of rural itself. I mean, the USDA's mandate is tied to rural development. That's in the name.
Right.
But as these limits keep climbing higher and higher to accommodate rising prices, they often end up expanding access in areas that are, frankly, rapidly suburbanizing.
Places that technically meet the population criteria on paper.
Exactly. But functionally, they're becoming extensions of major metropolitan economies. Exurbs, essentially.
So how does the USDA define rural in a way that allows these, fast-changing suburban fringe areas to still qualify for the program?
Well, the core definition usually revolves around population caps, generally areas with 35,000 people or less, or sometimes places deemed rural in character even if they're slightly larger.
Okay.
But the thing is, urban sprawl is moving so quickly now. Many areas that were genuinely isolated rural markets not that long ago are now highly desirable suburban or exurban communities.
Right.
And the policy challenge is this. If they exclude these expanding areas too quickly based on some strict definition, they end up pricing out thousands of potential moderate income buyers who could use the program.
Oh.
But if they keep raising the limits to keep pace in those hot markets, they risk effectively subsidizing housing inflation in areas that are already booming. It's a tough balance.
Yeah, it sounds like the program is constantly sort of fighting to maintain its original purpose while having to adapt to this relentless market reality.
That's a good way to put it.
So with housing demand, expected to stay pretty strong through 2025 at least, what's the long-term outlook? Are we likely to see continued flexibility?
I think the outlook is definitely that this flexible underwriting and these kinds of expanded limits are probably here to stay, at least for the near future. The USDA program really have to be proactive.
Mm-hmm.
And this projected 3% to 5% increase for 2025. It's simply recognizing that without this continuous support, that crucial zero down payment option would just vanish from many of these growing areas.
Which would defeat the whole purpose.
Exactly. It defeats the core objective of promoting sustainable homeownership in these designated zones.
Okay, so let's summarize that. The key takeaways from this deep dive.
Yeah.
It seems like the 2025 projections are basically good news for buyers, right? Forecasting an average increase of about 3% to 5%.
Yep.
Pushing that single-family average cap in many standard counties up towards maybe the $395,000 mark.
Absolutely. And that translates directly into higher purchasing power. Plus, thanks to that flexibility in underwriting we talked about.
The compensating factors.
Right. It means more nuanced qualification opportunities for borrowers, especially those who can bring those strong compensating factors to the table. The bottom line is the program seems to be moving with the market to keep that zero down option accessible.
Which perfectly sets up our final provocative thought for you, the listener, to maybe consider as you check out the USDA eligibility map for your own area.
Yeah, so here's something to chew on. Since the USDA basically has to keep raising its loan limits to keep pace with soaring property values, often in areas that are rapidly shifting from what we traditionally think of as rural to suburban, how might this necessary expansion of access, this chasing of higher prices, ultimately change the long-term character, maybe even the foundational definition of rural development in the U.S.
That's interesting.
As market pressure keeps pushing that financial ceiling higher and higher, is the program still serving those truly remote, traditional rural communities as effectively as it ends up serving the booming exurbs on the edges of cities? That's the fundamental balance the government is going to have to keep trying to strike moving forward.